Good morning. This is Nick Rach with the Earnings Scout, and many of you have asked whether S&P 500 EPS expectations are starting to improve here in September based on our rate of change chart that we shared on Monday, which is also on page 2 of our report released this morning where we're ranking our sectors. And you can see here, this is the chart showing the rate of change to overall S&P 500 EPS estimates over the past year. And before I begin to show whether there's improvement or not, let's take a look at what's actually been going on the last 3 years with earnings estimate changes and describe what our earnings score is measuring. The earnings score is measuring the direction and magnitude of overall estimate changes for the S&P 500, for all 500 companies aggregated up. We're not just looking at a single period, we're looking at multiple quarters, multiple years of estimates in a proprietary blend. And the nutshell is if the earnings score is negative, and you can see here, the scale goes down to minus 5.5%. What that means is over the last 3 years, at their worst, overall estimates were coming down at a rate of about 5.5% for the S&P 500. At their best, they were going up slightly. A positive number means estimates are going up. A negative number means estimates are going down. And in late 2021, you could see here what we had is the estimates were going down, and that was a negative delta as the price kept rallying. And when this happens, when we have two or more quarters in a row of estimate trends weakening for the S&P 500 and price continuing to rise, an alligator jaw opens. And an alligator jaw has opened it's opened 6 times. The last 3 times it's opened was in late 2018, 2019, and 2021. This is 2021 here. And you can see what the S&P 500 has done the last 3 times an alligator jaw has opened. It has fallen by 20%, 34%, and 23%. There is the drop in 2022. The peak to trough drop was 23%, with 2022 being a bad year for stocks. Why? Because the estimates are falling at increasing rates. Now, when we take a look here, when did stocks bottom? In October of 2022. And this is uncanny how this works. It's plus or minus 3 months of every market bottom over the last 35 years has coincided with the estimates dropping at their greatest amount. So as estimate trends improve in 2023, that's a great year for stocks, and we have the rally. Now keep in mind here, we know it does not matter. We want you to know it does not matter if estimates are going up or down. Throughout 2023, estimates were getting cut. Many people thought, well, the market's getting overvalued because of that, or they would look at it and go, the market doesn't trade off of earnings because the estimates are getting cut and stocks are rallying. No, what we want you to see is the expectation trends are getting better. They're falling at lesser rates. But what we've noticed over the past year is the revision trends have tended to stall out here. We're not getting that same improvement that we got in 2023. This has extended multiples up as price has risen. And more or less what we want to go where we think there's an improvement here, and what many of you are asking is right here, that tick up. There's that tick up right there. Now, I'm showing the chart over the last 3 years. I want to zoom in here. What we're going to do at the bottom of page 2 and what we're going to show right now, instead of a 3-year chart, we're going to zoom into the 1-year chart. Same data, but just looking at it over 1 year. And here we go here, same earnings scores. And you can see that there's going to be several factors here that contribute to where the estimates are falling at lesser rates. But we've been telling you the estimates are falling at increasing rates, and they've been weakening this earnings season. Why do we do this? In peak first quarter earnings season, we saw estimates come down at a rate of 0.73%. This earnings season, second quarter earnings season, we saw the estimates coming down overall at a rate of 1.53%. This is the weakness that we're talking about. But here's the improvement that many of you are seeing going, whoa, we're getting this big pickup to minus 0.6%. Is that an improvement or not? And what we're going to say is it's not. And what we're going to show you, there's several factors that go into the reduced estimate cuts to minus 0.6%. And one is as earnings season winds down, and we have very few companies reporting, after you have companies cutting estimates, the line tends to drift back up to the zero line. So if you think about it, when there's no revisions made, the earnings score is going to go to zero. So that's part of the reason it drifts up. And another driver of why this number has come up is we shifted focus here in September. We no longer are measuring third quarter 2024 EPS estimate changes. We rolled those off, and now we're focused on fourth quarter 2024 and beyond. And what we see is analysts tend to cut near term estimates more aggressively, but they hold off on making significant cuts for estimates further out. This is just the way sell side analysts operate. So as we move past those sharply cut estimates in second quarter earnings season for the third quarter, and we rotate to the fourth quarter projections, we see those cuts weren't as much. So that drifts that number up to minus zero point 0.6. So that's what we're seeing there. The true way to accurately compare to see if there's improvement or not is what we really need to do is do an apples to apples comparison of today versus 3 months ago at a similar point in time of earnings season. And if we look at that, we can actually do that and draw the trend 3 months ago. And 3 months ago, that black line shows you at the same point in time, the estimates were falling right at 0.3%. So you'll see there's real no improvement whatsoever in earnings expectation trends. And in fact, it's weakened a little bit. So where we're heading into third quarter earnings season here. So what we're looking at key here in this month, we're going to stress to you the critical importance of the companies reporting August quarter ends. These are going to be the early third quarter reporters. And we're going to compare their deltas to prior periods to see if there's any improvement to justify these high valuations in the market and to see if stocks can continue to rally in the second half of this year into 2025. And on a positive note, Oracle reported last night. It has been a key long-term holding in our long portfolio, ES long portfolio, and it is up 8% in pre-market trading. It topped estimates and delivered solid guidance. So the way we're looking at Oracle is it's the first batter up in third quarter earnings season, and it's on base with a hit. And this isn't bad for a stock that we've been holding for nearly 10 years as a core holding in our ES long portfolio when we were recommending it in the mid 30s. And it's trading at over 150 this morning. So it's a good start to earnings season, but Oracle is one company by itself, one that we've liked for a long time. We're going to need to measure more of these August quarter ends that report this month to determine if these rate cuts that are anticipated from the Fed are going to start to improve the outlooks that many market bulls are anticipating. So we just want to show you that it's no real improvement in the earnings expectation trend. It's more of a roll off of the estimates from the third quarter to the fourth quarter revisions that we're looking at now. And also through the passage of time, there's very few companies reporting the volumes low, so it drifts back up to the zero line. So don't think it's a sharp improvement. And if you have any questions about this, please get a hold of us. We'll be happy to share any of the information we have to help you make more informed investment decisions. Thank you.